Hey, it's Anthony Meiser with Land Title. I came to bring you our quarterly update. Let's dive right into some macroeconomic trends and just see what it looks like. I think one thing that we can really take away is we got to look big picture. What's the government doing? How's that going to affect the real estate market going forward? And what better place to look than debt versus GDP, right? We've taken $36 trillion out in debt, and that is seemingly leveled off. But as I'm filming this, we're sitting here in a government shutdown. So who knows what's going to happen in that realm, but we do know the GDP, $30 trillion, is lining up, obviously, less than our total federal debt. And when economies get into this vein where they're borrowing more than they're making, it puts so much financial pressure on the system that it really is not a good place to be, right? So they have a hard time reinvesting into other things and paying for other services like Social Security and, military, things like that. So just a heads up, obviously, the way that this is structured, top map, shorter term view, the longest view we can give you as far as historical data goes down below. Data here is coming from Fred. This is St. Louis, basically, organization coming out of the government who tracks and measures everything. So I'll kind of dial through this. Let's talk about the Fed rate and the T-bill, and really what is that going to look like going forward. So currently, the 10-year T-bill is really the closest thing we have to measure to interest rates, and really they track very similarly. And today, or I guess a couple days ago, as Wednesday, October 22nd, we were at 3.97 on the T-bill. So this is a good sign, one of the lower times we've seen all the way since last September. And there's been very few times we've trickled below 4 in the last few years, but it seems like a slow, steady change in the downward direction. So maybe that's a good sign for interest rates as they start to trickle down. But if you look at it over the history of time, interest rates are relatively low compared to where they've been really any time in the last 50 years. And definitely all the way back to 1960, as you can see here, there was a lot of times where, the treasuries were much, much higher. The one thing to talk about when you talk about treasuries is if we borrow more money, it's going to get more expensive because it's going to become less and less a safe investment. And the less money the government needs to borrow, the less T-bills they issue, so the more they would be worth. That being said, if the government spends a lot more money, this could stay stable for a lot longer. If the government decides to stay shut down longer and longer, it's hard to say what that's going to happen there, right? Because either they're going to borrow more money so they can all come to an agreement, or they won't. And one way or another, it's going to affect interest rates. Now, look at this one. This is the inversion of the 10-year versus the 2-year. And you can see that, the economists have been talking about the soft landing we've been going into. And it does appear that the 10-year minus the 2-year was only inverted for that short period of time from 22 to 24. And now we're sitting slightly above 1. And we seem to just keep carrying on. Now, they really, really do tell us about recessions coming most of the time. Out of the last 11 times that this has been inverted, you've seen recession 9 of those times. And you can see back in the 80s, it happened a couple of times. In the early 90s, obviously the dot-com boom in the early 2000s. We had '08, of course, where we had this huge, massive recession. Didn't last for too long, but here we are in one of the larger inversions of this, and we seemingly we're slow and steady, right? Higher inflation than we would like, but they really are projecting this soft landing, and it may be something that we're not used to seeing, and economists will learn from for decades to come. Personal savings rates I always like to track because this could be a good indicator of how hard it is on families. And the personal savings rate really hasn't changed much over the last few years. We're sitting at 4.6 today. That's 4.6% of their disposable income that they can put into savings. A lot of times, big economies around the world, are much more like what we were historically, 7 to 10%. But the U.S., because it's such a consumer-driven economy, has just been spending far more of its earnings than most for a very long time. If you look at M2, this is the supply of money. Supply of money really tells us how much we're devaluing our own currency in many cases, right? This is active dollars in the marketplace in order to keep everything running. And we have $22 trillion today active in the marketplace. And steadily over the course of the last couple of years, you've seen the supply of money continue to grow. And truly, that's part of what's causing some of this inflation that we experience in the marketplace, amongst many other things. But this is what gives the dollar less and less value over time. And so you can see over the history of time on the planet, we've printed and printed and printed more money. And that has accelerated pretty drastically since those pandemic times. Okay, so can the Fed cut the deficit? I guess that's the better question. This administration and things that are going on in this country right now are really not allowing that to even happen. It seems like everybody just wants to spend more money when we probably should be doing the exact opposite. It's been all the way back to the Clinton administration where we actually had a positive increase in, the actual amount of money coming into the government versus what we've been spending. So most of the time, for basically since the 80s, we've been spending more than we've been making, but it's been nominal, right? And then all of a sudden the pandemic hit, we were spending, $1 trillion, $800 billion in a month or a quarter, as we're kind of tracking through now. And so you've seen this bounce around quite a bit, but I think the trend very clearly was, we spent a lot of money trying to get us out of the Great Recession in 2008, 9, 10. And then we slowly tapered that spending back into, maybe the end of the decade. And then all of a sudden we were spending more money. Pandemic hits, we print $8 trillion. We do all this other crazy stuff. And then we just have not gotten our spending back under control. That's going to create a lot of problems for the US economy going forward. So, it is what it is, but there's the data. The unemployment rate, being that, I'm sitting here in Boulder, I've been comparing unemployment rate for the nation to the state to Boulder County. It's a good metric to look at to kind of see how things have changed, but unemployment rates have been rising through the last couple of years. You can see that, when we're at maximum employment, we should be somewhere around 3%, and we're not at maximum employment, right? We're now having some higher unemployment rates, and this is a leading sign of why the Fed would probably continue to lower rates if, all this other stuff doesn't factor in sooner. But the first Fed rate cut in September really was due to the rising unemployment rates, right? And inflation staying fairly stable. Now you can see over the history of time how that unemployment rate kind of ebbs and flows and rises and falls with recessions. And, we're not necessarily headed into a recession from all the economic indicators, but unemployment rate is something we definitely want to track. Now, Colorado usually has better unemployment rates than the nation. And all of a sudden here we are, the higher end jobs that we have in Colorado seem to be correlated to a higher unemployment rate, Boulder County being fairly similar up until fairly recently. But keep an eye on this. This is the one metric that Powell's continuing to look at. I think that personal income per capita is probably one of those things too. It correlates so well to housing because the more money you make, the more house you can afford. But the difference being that the nation sitting at a median house price of $400,000 or 412 or something like that today, correlated at, today we're sitting at basically $80,000, not quite $75,000 is the per capita median income across the United States. Boulder County in 2013 hit 100,000, but house prices were more than double that, right? So it's not necessarily the same, right? We're paying significantly more for housing here locally. Colorado is trending kind of on that same line, higher paying jobs, but higher cost of housing. Now, NAR always gives us a bunch of statistics. Improving on housing affordability is also contributing to the increase in sales, according to Lawrence Yun. And Lawrence Yun's great. He's their economist there. The one thing you need to remember is the existing home sales are starting to slowly rise, right? Buyers are slowly coming back to market as things get a little better for them. Year over year, we're up 4%. That's a good sign. Month supply of inventory, though, is still slightly rising, and nationwide it's at 4.6 month supply of inventory, which, according to Lawrence and NAR, is a balanced market across the country. So buyer and seller similar to even footing, right? Which is why you see home prices being fairly stable. Year over year, the median sales price only went up 2%, which is probably a lot of what they wanted to happen after the insane market during the pandemic times. Now, if you look at this slide, I like this slide because it gives us a little bit easier to read graph. Now, I like the blue lines because they tell us how many sales are taking place in the last year, and they make it very easy to compare to past decades. We're nearly 1 million homes less selling every single year right now than we had in the last decade. So across the whole decade, right? I mean, outside of those 08, 09, 2010 timelines, we really are kind of back in that same realm. And it's just a very rock bottom market for total sales volume. But you can see median sales price over this period of time has still slowly been trending up. It's not like it's flatlined or anything across the nation. So it's just a low level of participation, but it has slowed growth. It just hasn't stopped the price of home rises, right? Because we just don't have enough supply for that. If you look at the housing price index, I like this one because the housing price, the blue line represents our median sales in the country, right around that 410,000 mark. The average is 512. And then all transactions in that price index has been slowly, steadily rising. So it's just getting more expensive to purchase real estate in this country. Now, the interesting thing that has been worth noting for a while is basically post-pandemic to now has been a much wider gap between the median and the average sales price, which means we have much more higher income folks purchasing luxury real estate or higher end real estate, and the median has been very stable. Now, if you look at it, this is the 30-year fixed interest rate. As of yesterday, when I filmed this video, it was at 6.19%, and that has been a fairly good rate for a while, right? I mean, you can see over the last few years, obviously back in 2021, we had that 3% rate that everyone's kind of stuck on, but we're not headed there anytime soon because you can see as we quickly raised the Fed rate, and then we absolutely decided that we were going to leave it as high as long as possible to try to take some of that money out of the economy. It does drastically affect mortgage rates, and now we're slowly trickling back down. Now, I don't know for how long this is going to last, and obviously it matters what's happening with Powell and with the U.S. economy, but for right now, slow, steady decline, and 6.12, if you look at the history stuff down below, is fairly normal, right? Outside of the last 2 decades, it was much, much higher than that for a long time. So it's not that the real estate market can't operate at this level. It's just it may not be conducive to many people with lower interest rates that they were locked into for 30 years. Being that we're one of the only countries in the world that does that, it's probably why we don't have a lot of housing change, even with the higher interest rate environment, for better or for worse, right? It's great for homeowners. Now, if we look at the supply of active listings on the market, this is Colorado versus the U.S. versus Boulder County. And I think the one thing you got to see here is we're in such a low inventory environment for so long in Colorado. The U.S. was much higher. And then we hit the pandemic. Everybody went down together. Very rock bottom inventory levels. But Colorado has had this need to sell real estate more so than the country. And that's created a rising inventory environment much faster in Colorado than other places. So our real estate really is truly taking a hit because of that. New listings coming to market, you can see over the last 3 years, way more houses going on the market for sale in Colorado than other places. Just another reason compounding that effect. Let's look at the month supply of new houses. And the interesting part, this is new build homes, right? So as we look at this, you can see rising up to that point where we're in the 9s. Very bad market for builders, right? They definitely do not want 9 months of inventory to sell. You can see that usually doesn't happen. They really try to stick around that 6 months or less market when you're measuring this. And anytime it's been much, much higher, it's been high recessionary periods. And right now we are down to 7.4 for the month, but I don't expect it to stay there, right? Because this is still hard. The issue being that new builds will stop coming to market or to fruition, right? So they will stop doing lot development, all this other stuff, if it's just too high. So we could easily end up in another major housing shortage, just like we did after the Great Recession, because it's just too hard for builders to build homes and make any money doing it, which has created many, many problems in the past, which expect to see again. Demand for pending sales, obviously, Colorado has had a slower level of demand than the United States, but it is very similar still. So as we start to trend up just a little bit with this recovering sort of market that we're starting to enter, just a little bit more sales than we saw a year ago, that's a good sign. The median days on market, though, you can really see Colorado and Boulder have been higher than the national average, but not too much. We're talking about a week between the US and Colorado. And Boulder is very similar, only by a couple of days is different. Now, median days on market year over year, this really tells us the change in the transition over time. So you can see just the housing inventory median days in Colorado and what that's looked like over the course of the seasonality. But look at the change in those other two, the median and the list price. As days in MLS start to change and get bigger and bigger, it really has created that vacuum and that pressure on downward pricing. So the city of Boulder, or Boulder County specifically, has had a price depreciation during this time of higher days in the median on the market, because the longer you're on the market, the more pricing pressure you have, right? The more competition you have. All right, let's talk showings. I think showing is really important here because the Western region is still really struggling with showing traffic, less buyer participation than most of the rest of the country. The Northeast represents so much of what's happening with the total showings out there that you can see we're at a 78 versus a 109. This is a metric, so it's not the number of showings. But that metric for the last, really 3.5 years has been super depressed because prices went up so much in the West so fast. And now real estate is more expensive, especially at that higher price point. The other thing that is probably worth noting, this is Colorado specific, but showing traffic did not bounce up super fast as interest rates have started to trickle down a little bit. They've almost been very stable for this time of year. Last year in September, when interest rates dipped down a little bit, the price started to, or the buyer participation started to rise just a hair, which kind of kept us in a better market for longer, more of a plateauing third and fourth quarter. And then here we all of a sudden with a much more normalized experience. It is a little bit better in some ways than maybe you would expect if you expected nothing, but a muted response to those lower interest rates. So hopefully they can stay longer so buyers start to get wind of that once they feel some certainty and are ready to go buy a home. Okay, I show this graph. There's 4 of these. This is the last thing I've got to show you today. This is quarterly price change. You can see Colorado there at 7 points or 0.76 change in the last quarter. The national average was 1.4, but there are certain markets that are doing remarkably well. I mean, look at Nevada, 3.5% increase, or over into maybe Connecticut at 2.8% increase. Then there's other places doing much, much worse, like Delaware. It actually lost value in the last quarter, which kind of places like Arkansas also experienced that same market. Now, in the last year, you've seen it in the Northeast very exclusively. Lots of price changes. And then, of course, places like Nevada, Montana, Idaho, Wyoming, Nebraska, and Kansas, places with more rural real estate have done better in the last year, probably because the price points in some of those places were quite a bit lower. It makes more sense in the Northeast in the same respect. Also, supply shortages, right? Now, if we look at the 5-year view, only places that have really done phenomenal are Florida, Montana, Idaho, right? And then some other places around DC, Tennessee, right? And the high Northeast. So that's always fun to watch from a longer term perspective. And naturally, if you want to see who is the winners in real estate appreciation, maybe this is good, maybe this isn't, but Colorado is always at the top of the list there at 596% since 1991, when a national average was almost half of that. So that was a tough one. But when you compare what's happening now in the Northeast to the 1991 and prior, most of that region is what appreciated the absolute least. So now it's the more affordable marketplace going forward, which seems to be why there's so many people purchasing in that region. Well, hopefully this was helpful. Thanks for joining me for the quarterly update, and I hope to catch you next time. This is Anthony Meisner at Land Title. Don't forget to like and subscribe to the YouTube channel. See you soon.